Okay, in this, another very important rule. Rule number 8 for the professional and wealthy investor. Risk management. These are rules which save you money, and it's very rarely understood by private investors what the actual importance of this is. So let me go into some detail. This is what one leading trader described it as. The worst I do is a 1-to-1 reward to risk ratio. Most of the time I want a 2-to-1 ratio or 3-to-1 ratio. So if I think a stock is going to $35 and it's currently at $31, then I sell at a loss if the stock goes to 29. So I have a multiple upside to downside. This is what it currently is. I'm looking for it to get to 35. That's a $4 move. So if it goes to 29, I have to get out because then my risk reward or my reward risk is at a multiple. It's 2-to-1. You cannot be willing to say, I'm going to ride the stock to 20 to the downside if I'm wrong, but I'm going to make $4 if I'm right. Do that kind of thing, you're just not going to be in business for long. That's incredibly important as a risk management, money management rule. And we have to see in actual trades how that plays out, what it actually means. Let's have an example. Let's say we were looking at this price chart of Abbey National. And let's say this is today, and we look at it. And we do several things. Let's just keep it really simple. We draw a rough and ready downtrend line over here and see that the stock is trending downwards. We also notice that it's broken out above the downtrend line. So for argument's sake, just for the purpose of this example, let's say we say, look, I think that's a breakout and the stock is going to move higher. So the first thing I've got to do, and also incidentally, this is taken out of one of my trading systems, but I've simplified the number of charts and indicators I look at. For those who are interested, I'm looking at the MACD, or Moving Average Convergence Divergence. Don't worry if you don't know what that is. For the purpose of this example, it's not that important. I'm also saying that the MACD is broken above its signal line, it's from oversold territory, and it's creating a series of positive divergences. All of those issues beneficial. Now, I know that might seem like jargon to a lot of people, but for those who are into charting, they'll understand what I'm talking about. The point is, ignore all of that, the point is I want to show you a theoretical example of what actually happens. So we get a breakout and we think we want to enter here, we want to buy there. So the next step is, well, what kind of target might we get? So I look up here and I say, well, you know, this is a good target because there's a lot of price resistance up there. And if the MACD is behaving in this way and we've got a genuine price breakout, then this is a realistic target to examine and to shoot for. So I say, okay, that's about an 80p gain from this level here to this point up here. It's about 80p. Okay? But what is my stop loss, initial stop loss? At what point do I know I'm wrong? Why do I know I'm wrong here? Well, I know I'm wrong because if the price, given that I think it's going to break out above its downward trend line, if I think the price is supposed to be going upwards, then one thing that shouldn't happen is it shouldn't go back beneath this downtrend line, and therefore if I put a stop loss initially here, I should pretty much know that should the price hit there, I was wrong and it's time to get out. So my stop loss is 40, my reward is 80, so that's 2 to 1. Now you're not always looking at 2 to 1, sometimes you might look at 1.5 to 1, that's fine. This is just to give you a typical example. That is money management and risk management rules which end up saving you money. We'll look at a lot more of those in the detailed charts, but let's see what then happens. If we fast forward that Abbey National chart, we did get in here, and we did indeed, guess what? See it rise and rise, and it did hit this level, drop back, and then went sideways. So, not bad. It was a well-structured trade which gave us a significant return. If we were a spread better, and we were looking at that 80p, and maybe we got in at £100 per point, that's £8,000. £10 a point, that's £800. Either way, not bad returns in a short period of time and with limited risk. If we were shooting for £800 on the upside, our maximum loss for that was going to be £400. £400 risk for an £800 gain. That's not bad. Guess what? A lot of private investors don't do that. They go for a £800 loss just for a £500 or £400 gain. So you can see from risk-reward analysis there how we can structure trades and how we can do this until the cows come home, one after another after another. There's lots more examples I could take you through. Not enough space obviously in this CD to go through all of those different examples and trade structuring, but that gives you a bit of a taster of how that works. Well, what are the kind of questions you need answered if you're looking at risk management rules? Several. How do professional investors handle losses? What do the world's leading traders say about risk? What are the classic private investor mistakes in this? And I give about 5 errors which I bet private investors make when they're looking at risk management. But there are other questions we need answered as well. Simple calculations to save us money when we're trading. What is the right level of reward for the right level of risk? When do you know to take a loss to avoid a larger loss, as opposed to pyramiding? And what do you do if a trade goes up after you've sold it? Do you get back in? Do you just say, look, I missed it, forget it? How do you know? What are the rules regarding that? What's the right win-loss ratio? Is it 7 wins to every 3 losses? Is it 5 to 5? Or is it completely irrelevant? What about finding low-risk, high-return trades? And what's the most you should ever lose on a single trade compared to the overall amount of money you have in your portfolio? If you've got £100,000 in your portfolio, how much should be bet on individual trades? What are the professional rules for deciding that which will save money, if not make money? And how can you try to right a trade which has actually gone wrong? So that's rule number 8, which is trade structuring, and I showed you an example of that and also some of the questions you need answered. Next, we'll move on to rule number 9.